Market on a roller coaster. Listen up, investors. The first quarter of 2025 has been a wild ride. We've seen more twists and turns than a Wall Street thriller. Volatility is the name of the game. Fasten your seatbelts because this roller coaster is far from over. Since the start of the year, the Dow Jones Industrial Average is down 5%, the S&P 500 has shed 7%, and the tech-heavy NASDAQ composite has taken the biggest hit, plummeting a staggering 12%. Investors are nervous, and rightfully so. Uncertainty is swirling around the globe. But don't panic, we're here to break down the market mayhem. We'll analyze the winners and losers, dissect the driving forces behind these moves, and equip you with the knowledge to navigate this turbulent terrain. Knowledge is power, and we're giving you the tools to take control of your portfolio. Tech, the darling of the 2020s, is facing a harsh reality check. The NASDAQ, home to tech giants and innovative disruptors, has been slammed. High-growth darlings that soared during the pandemic are coming back down to earth. Rising interest rates are the main culprit. The Federal Reserve's fight against inflation has made borrowing more expensive. This directly impacts tech companies that rely heavily on debt to fuel their rapid expansion. Investors are reassessing valuations, leading to a mass exodus from growth stocks. Remember those stay-at-home stocks that skyrocketed during lockdowns? Zoom, Peloton, Teladoc, they're all feeling the pain. The reopening of the economy has diminished their pandemic-fueled growth, and investors are moving on. While tech stumbles, renewable energy is shining bright. Concerns about climate change and the push for sustainable solutions have propelled clean energy stocks to new heights. This sector is a beacon of hope in a sea of red. Solar panel manufacturers, wind turbine producers, and electric vehicle companies are riding this wave of optimism. Governments worldwide are pouring trillions of dollars into green initiatives, creating a massive tailwind for the industry. Investors are taking notice. The iShares Global Clean Energy ETF is up over 15% year-to-date, demonstrating the strong appetite for sustainable investments. This trend is here to stay. Remember the energy crisis of 2022? Well, the tables have turned. After a period of record profits, the energy sector is facing headwinds. Oil prices have retreated from their highs, dragging down energy stocks. Several factors are contributing to this decline. The global economic slowdown is weighing on energy demand. Renewables are gaining market share, and OPEC plus production increases are easing supply constraints. ExxonMobil, Chevron, and ConocoPhillips have all seen their stock prices slide. Investors are questioning whether the energy sector's bull run is truly over. Is this a buying opportunity, or a sign of further weakness to come? Section 5, Inflation Nation, the Fed's Dilemma. Inflation, the word on everyone's mind. It's the economic bogeyman that just won't go away. While inflation has cooled slightly from its peak, it remains stubbornly high. This puts the Federal Reserve in a pickle. The Fed has been aggressively raising interest rates to combat inflation, but they're walking a tightrope. Raise rates too quickly and they risk tipping the economy into a recession. Move too slowly, and inflation could become entrenched. Investors are closely watching every word from Fed Chair Jerome Powell. His pronouncements on the future path of interest rates can send shockwaves through the market. The Fed's next move will be crucial. Section 6, Consumer Confidence, a mixed bag. The American consumer, the engine of the U.S. economy. But their confidence is waning. Inflation is eating into their wallets and recession fears are swirling. This has implications for corporate earnings and overall market sentiment. Consumer spending accounts for roughly 70% of U.S. economic activity. If consumers tighten their belts, it will have ripple effects throughout the economy. Retailers, restaurants, and travel companies are all vulnerable to a pullback in consumer spending. However, there are some bright spots. The labor market remains strong with unemployment near historic lows. This provides a buffer against recessionary pressures. The consumer is resilient, but for how long? Section 7, China Syndrome, Global Impact Looms. China, the world's second-largest economy, is facing its own set of challenges. The country's strict zero-COVID policy has disrupted supply chains and hampered economic growth. This has global implications. China is a major consumer of commodities and manufactured goods. A slowdown in China's economy has ripple effects throughout the global supply chain. Companies that rely heavily on China for manufacturing or sales are facing headwinds. Moreover, geopolitical tensions between the U.S. and China continue to simmer. The ongoing trade war and the potential for conflict over Taiwan add another layer of uncertainty to the global economic outlook. Section 8, the bond vigilantes are back. Remember the bond market? It's not as flashy as the stock market, but it's just as important. And right now, the bond market is flashing warning signs. The yield curve has inverted, a historically reliable predictor of recessions. An inverted yield curve occurs when short-term interest rates are higher than long-term rates. This signals that investors are pessimistic about the long-term economic outlook and are demanding a premium for lending money for shorter periods. The bond market is often seen as a leading indicator. While the stock market can sometimes be irrational, the bond market is considered more rational and forward-looking. Investors should pay close attention to what the bond market is saying. Section 9, Crystal Ball. What's next for investors? Predicting the future is a fool's errand, especially in the stock market, but we can use the information at hand to make educated guesses. So, what can investors expect in the coming months? Volatility is likely to persist. Uncertainty about inflation, interest rates, and economic growth will continue to fuel market swings. Investors should brace themselves for further turbulence. Stock selection will be crucial. Not all stocks are created equal. In this environment, it's more important than ever to identify companies with strong fundamentals, pricing power, and a clear path to profitability. Don't forget about diversification. Spreading your investments across different asset classes, sectors, and geographies can help mitigate risk and smooth out returns. Section 10. Don't just sit there, get in the game. The stock market can be intimidating, especially during times of volatility. But remember, investing is a marathon, not a sprint. Don't let fear paralyze you. This is not the time to sit on the sidelines. Educate yourself. Knowledge is power. Take the time to learn about different investment strategies, research companies, and understand the forces that drive market movements. Start small. You don't need a fortune to start investing. Many online brokerages offer fractional shares, allowing you to invest in expensive stocks with a smaller budget. Consider working with a financial advisor. If you're feeling overwhelmed, a qualified financial advisor can help you create a personalized investment plan tailored to your goals and risk tolerance.